What a bit of a wild ride it's been for Alibaba. After earnings, it just went down 10%. Hi everyone, JJ here with The Art of Value. Welcome. Well, today we're going to look at Alibaba earnings for Q3 2023. This is condensed down to the main points from a much longer near live video I did on stocks today with JJ. Hope you get value out of it. Let's just get straight into it. It's down 48% over the 5 years, which is incredible. And for maximum, we can see it's down 17%. Pretty much since the IPO, you'd be down. Incredible. So since that top, since the peak, down 75% still, but the bottom of that was more like 80%. So it really hasn't moved much. As I said, this year to date, we're nearly at the end of the year, not many trading days to go. When's it going to pick up? If we look at Dataroma here, we can see the investors who currently own it, the so-called super investors. For the last quarter, we can see Charlie Munger, still he hasn't sold Alibaba. And then we have Michael Burry has initiated a position. He's quite a trader these days. You know, he's famous for The Big Short, of course, for making a bet against the housing market, but he also goes long. He's a deep value investor really at heart, and he's taken a position in Alibaba, which is 9.88% of his US portfolio. David Tepper has reduced by 20% from Appaloosa Management. He's done very well over the last decade or more as a fund manager. Guy Spear has a 2% position for his US portfolio. He's done nothing. Lee Ainsley, 1.68% investment firm. Prem Watsa, and a few others there you can see on the screen. So there are a number of investors who still invested. Some of those are pretty low allocations, but Charlie Munger being the significant one there. And he hasn't sold out. He's known for holding for a very long time. He did sell about half, and it was thought, I think he might have even said it was for tax loss harvesting purposes. So those are the big investors, the famous investors who still own Alibaba. We'll look at some of the articles that have come out since earnings. Chip war nixes Alibaba's plan to spin out cloud business. Now this is a big reason I think that sent the share price down 10% after earnings. This was disappointing because those US cloud businesses, very strong. We've got, you know, Microsoft, Google, Amazon, all of them well into double-digit growth. And we have Alibaba. Alibaba has dropped plans to spin off its cloud computing arm, sending its stock tumbling because of US controls on chip exports to China, which the company said had created uncertainties for the division's prospects. The announcements came only hours after crucial talks between Chinese President Xi and US President Biden appeared to put the often rocky relationship between the world's two economies on a steadier footing. That's true. Handshakes and all seems fine. They've laid out the red carpet there in San Francisco, but then, you know, the restrictions hurting their cloud group. So geopolitical tensions really kind of weighing on Alibaba in particular there. A lot of investors have concerns of this, about these geopolitical tensions outweighing fundamentals, because Alibaba's fundamentals are not bad, as we'll see. In a statement Thursday, Alibaba said the new US restrictions may materially and adversely affect the ability of the Cloud Intelligence Group to operate, impacting on profitability and casting doubt over the value of a separate listing for shareholders. So the idea was to increase value, to realize value for shareholders because of this huge downtrend that it's had, but it's not really going to plan, is it? We will focus on developing a sustainable model for Cloud Intelligence Group under the fluid circumstances, the company said. These new restrictions may also affect our business more generally by limiting our ability to upgrade our technological capabilities, so really hindering their ability to grow, to reinvest in their technology. They just can't get what they need. That's what they're saying. So we'll have to believe them. So this chip war really weighing on stocks, and also the economic situation in China not so good. The two countries have been locked in a year-long feud over China's access to the most advanced semiconductors, as well as the materials and equipment needed to create the components. Last month, the US government further tightened a sweeping set of export controls first introduced a year ago, effectively reducing the range of semiconductors that American companies are able to sell to China. So it's going to hurt American companies too, mind you, but really, obviously, Alibaba is saying that it's going to hurt them. Will this meeting between Biden and Xi, will it ease tensions here? Will that help a little bit? Doesn't seem to be at the moment, especially with Alibaba coming out with these concerns. Well, more than concerns, it's affecting their business. During talks with Biden Wednesday, Xi described the restrictions as technological containment, according according to a senior US official. Biden said in a response that the United States is not going to provide technology to China that could be used against it by the Chinese military. So that's the justification. But there's also, it's more of a kind of trade war going on. Biden called Wednesday's talks between the leaders some of the most constructive and productive discussions we've had. Proof is in the pudding, as they say. His comments came amid a slump in foreign investment in China, which is also grappling with deep property crisis and weak consumer spending. So the macro situation not looking good there. They do need foreign investment, so they can't sort of shut people out. I mean, China used to do that, and all the growth that it's had and all the development it's had has been because of foreign investment. Really, it's been a big part of it. Alibaba, which was founded by billionaire Jack Ma 25 years ago, is in the midst of an historic overhaul that was originally meant to create 6 separate units, each overseen by its own chief executive and board. So they want to spin off these 6 sectors. CNOW is one of them. Their logistics arm, they haven't said they've called that off. That's actually one of the units that's growing really well. We'll see that in the financials. You can see that the international, like AliExpress, the international division, and CNOW Logistics are the ones that are growing the fastest, double digits, well into double digits percentages. The group said Thursday that it is also pausing plans to list its supermarket chain Fresh Hippo to evaluate market conditions. So another delay on one of its IPOs, but it confirmed plans for an IPO of its logistics arm, CNOW, in Hong Kong without providing a date for the listing. So no date yet again, so that will weigh on the market as well. Could they call that off too? Alibaba's revenues for the June to September quarter climbed 9% on the previous year to 31 billion. Net profit was 3.7 billion US dollars compared with a net loss previously due to the increase in the value of the group's equity investments. The fundamentals they're not bad, well, compared to the market cap at this point. Now, if you're getting value out of this episode so far, don't forget to hit that like button wherever you're watching, whether it's on YouTube or on X or on Rumble, to help the algorithms to spread it to more people. If you want to take your appreciation to the next level, Super Thanks is now turned on YouTube, or you can also go here to buy me a coffee, link in the description. I'd really appreciate your extra show of appreciation. Thanks. Alibaba chairman Joe Tsai said that the company has never been in a better financial position to invest in its business growth as it ended the quarter with 63 billion in net cash. That's key. It is so much. Their net cash position is pretty incredible. When you look at their overall market cap compared to the actual cash that they have, I mean, it's pretty incredible that the share price isn't more than it is, but that's the way it goes. So I said that despite the global uncertainty, the operating environment has improved and is more stable. Alibaba also revealed it recorded healthy year-on-year growth of its Taobao and Tmall domestic online shopping sites. Well, growth wasn't stellar, as we'll see in the actual figures. CEO Eddie Wu stated that going forward, Alibaba will be performing a strategic review of its businesses in order to separate core businesses that demand long-term focus and commitment to non-core operations. AI is at the heart of its strategic direction, it said. So they're all talking about AI, of course. It's the flavor of the moment, and it's real. AI is real. There's some real development going on. Alibaba did state that AI is a big part of its strategy going forward. That front is already crowded and with competition from Tencent, which Manish Pabrai has invested in rather than Alibaba. He sort of famously sold Alibaba to go into Tencent through another company called Process, which owns a big chunk of Tencent. And Baidu, as well as US tech titans, namely Amazon, Meta, and Google or Alphabet. And Microsoft backed OpenAI. Interestingly, Baidu, who is among the leading AI firms, warned this week about the consequences of China's rush to develop AI models. On Wednesday, Baidu CEO Robin Li warned that all that rush to develop large language models could result in a waste of resources. That's what happens in bubbles. Too much is developed. We believe that a full spin-off of Cloud Intelligence Group may not achieve the intended effect of shareholder value enhancement. They did say that on the earnings call. The business highlights in the quarter ended September 30. Income from operations was 4.6 billion, an increase of 34% year on year. You have to see it over a longer period with Alibaba because, if you think about the last few years, it's been pretty lumpy. So year to year is sometimes not a good measure. You have to, normalize it out over longer years. The year to year increase was primarily attributable to an increase in adjusted EBITDA, as well as decrease in the share-based compensation expense. Decrease in share-based compensation, always good to see. So one thing that we haven't mentioned there is the dividend. They decided on a dividend. We'll get to that in a minute. September quarter results. Let's look at some of the tables. We can see there the Taobao and Tmall, the year-on-year growth. Taobao and Tmall, 4%. Alibaba International Digital Commerce Group, 53%. Local Services Group 16%, Seniao 25%, and Cloud only 2%. This is biggest to smallest. So Taobao and Tmall only 4%. The biggest is growing only 4%. Alibaba International is growing 53% year on year. That's impressive. That's impressive growth. International. Local Services Group 16. So 25 is the next biggest. So Seniao very strong. But overall, we can see that total segment revenue, this revenue, is 9%. It's not your fast-growing company at this point. You know, so even some of the US megatechs have grown faster than that. You can see all these figures here. The cost of revenue and operations. So there's their efficiency of the operation is pretty much stable. Net cash position 62.7 billion at the end of September. Revenue from our China commerce retail business. So yeah, this is the core. You know, China commerce, this is where they built their business. E-commerce, retail, increase of 3%. Logistics, see now, we see that a 25% growth. Got the gist of what's going on with their business. It's not bad. There's some high growth areas and then some low growth areas. We are confident in our business fundamentals and are pleased to announce our first annual dividend distribution for fiscal year 2023. With an aggregate amount of approximately $2.5 billion as part of our continued efforts to enhance shareholders' return, in addition to the ongoing share repurchase program. So they're still buying back shares, but they're giving this dividend, which is questionable. Warren Buffett would not like to see a dividend, probably, if they could just reinvest back into those high growth areas, for instance, but they do have a huge amount of cash, so it's kind of a token gesture to pay out a dividend, but I would rather they not. When you pay out a dividend, redistribute to shareholders, tax has got to be paid from that. If they reinvest back into the business at a high rate, I talk about this over and over again, we look for businesses that can take the money and reinvest it at a high rate of return. That's what you want. That's what you want to look for. And so Alibaba's building up a huge amount of cash here and they're starting to give back. But given the situation, the share market situation, perhaps they think this is a way of boosting the share price. But they do have a share buyback program. I mean, when shares have gone down this much, 75%, wouldn't it make sense to buy back more shares than give a dividend? But having said that, there could be other reasons for that. There's this Chinese government situation. You have to consider that. Is it in China seen as not a good thing? They might be being conservative about buybacks here and giving back as a way to sort of appease. Could be part of that. We just don't know. I certainly don't say anything like that. Toby Zhu, Chief Financial Officer of Alibaba Group. Under our capital management plan, we are prioritizing investment in technology and innovation for our business to drive new growth. But as I said, I would prefer to see that reinvested and not have a dividend, and for them to grow the business and realize value that way. But we'll have to see what happens. You need to give these things time, I think, just in my opinion, not investment advice, but 3 years at least. I haven't had it for 3 years, so we'll see what happens and then reassess after 3 years. Alibaba's just had such a bad run. It's been incredible. And as I said, I'm getting more into small caps. This is the biggest cap I had, and it's been pretty much one of the worst investments I have. So we'll see what happens in the coming quarters and over the next year or so. But the fundamentals of Alibaba aren't bad, in my opinion. I mean, there's some really bright spots there, some still growth, obviously cloud, and that chip situation, the tensions. There's a lot of geopolitical risk with Alibaba that's sort of playing out. But these things can change over time too. We'll have to see what happens. At this point, I'd really like to know what you think. What do you think of Alibaba as an investment at this point, or do you own it already? Do you think it'll be a good investment over the long term or a bad one? It's certainly had rough times over the last few years. What do you think? Let me know in the comments. Thanks for watching or listening, and I'll see you in the next one.